Hi, Strangle is a neutral option strategy that profits from a lack of stock price movement. If the stock price fluctuates beyond our expectations, there are a few adjusting strategies that can help us repair the losing Strangle by increasing credits received to offset the losses. Then we can patiently wait for the stock price to revert back to our range of profitability. We'll talk about 4 key points today. 1. What is Strangle? 2. Roll up put after the stock price goes up. 3. Roll down call after the stock price goes down. 4. Roll forward the straddle just before expiration. A strangle is the combination of a short put and a short call to create a neutral strategy. The trade is profitable if the stock price doesn't change very much. The short put defines the lower boundary of the stock price. The short call defines the upper bound of the price movement. As long as the stock price stays between the strike prices, the strangle options will expire worthless, resulting in profit for the option seller. We can see a 20 delta TSM ADR strangle that expires a month and a half later has a 67% probability of profit and has the highest return on capital of around 26%. If the stock price goes up before the strangle expires, we can roll up the profitable put option to pocket the profit. In the TSM strangle example, when the TSMC stock price goes up, our short put becomes profitable due to a lower delta, while the short call on the other side loses because of an increase in delta. We can roll up the put option to collect some profits first, buy to close the put option, and sell to open another put option that expires at the same time at a higher strike price. After rolling up, we create a strangle with a smaller profitable width, allowing us to continue to benefit from theta decay. If the stock price continues to rise, we create a straddle after rolling up the put a few times. Then the profitable range would be defined by the premium received. We can close the trade for profit if the stock price remains within the range before expiration. If the stock price goes down before the strangle expires, we can roll down the profitable call option to pocket the profit. If the TSMC stock price goes down, our short call becomes profitable due to a lower delta, while the short put on the other side loses because of an increase in delta. We can roll down the short call to collect our profit, buy to close the call option, and sell to open another short call that expires at the same time at a lower strike price. After rolling down, we have a strangle with a smaller profitable range, allowing us to continue to benefit from theta decay. If the stock price continues to fall, we create a straddle after rolling down the short call a few times. Then the profitable range will be defined by the premium received. We can close the trade for profit if the stock price remains within the range before expiration. If the straddle is unprofitable less than 14 days to expiration, we can roll the straddle to a later date. We can see a TSM straddle near expiration is running out of value. If we believe the stock price can revert back within the profitable range, we can roll the straddle forward to a later expiration and use the extra premium to offset previous losses. Buy to close the current put and call options and sell to open future put and call options. It will result in a straddle with a longer expiration, letting us create a wider profitable range with the additional premium received. Then we can wait for the TSM stock price to revert back within our expectation and profit from the time value decay. Now you don't have to worry when a strangle strategy goes bad. We can repeatedly roll up or roll down the profitable legs until we get a straddle. When it is close to expiration, we can roll the straddle to a later expiration and wait for the stock price to revert to our expectations. If you enjoyed my video about trading options, please like and share my videos and subscribe to my channel. Thank you.